Now, please confirm you can hear me clearly.
Good evening, sir.
Yeah, thank you for that, Shari.
You're
All right,
welcome.
I've been trying to connect. Is the network that has been a bit, albeit, please always check the time. The time is always between 8:30 or 8:45. The 15 minutes is to allow, because some they didn't get back home early enough. So it's 15 minutes grace to allow that student to get in. Now we are good to go. For those that were in class last week, we looked at capital structure and theories of gearing. We explained that as a way of recap, we explained first what is capital. The money we use to create a business, to build a business, and to run a business. We define capital as the money used to create a business. When you create your business, next is to build your business. You also require money to build your business. Then you require money to run your business. So capital is the money used to create, build, and run a business. We look at the types of capital. You have equity capital and debt capital. What is equity capital? Capital contributed by the shareholders. Money contributed by the owners of the business. What is debt capital? Debt capital refers to all forms of borrowing. Anytime the company is borrowing money, that will be classified as debt finance. Debt finance also includes preference share capital. We now look at what is capital structure. The capital structure of a company shows the different combination of capital the company uses to carry out its activities. The capital structure of a company shows the different types of capital the company uses. You can have in a capital structure, this may include ordinary share capital, preference share capital, long-term debt capital, such as debentures, loan stock, and what have you. We explain further that a company may be financed by equity capital only. If you finance your business with your own money, that is equity capital only. Where a company is financed by equity capital only, such company is regarded as ungeared company. We explained this last week. Alternatively, where a company is financed by a combination of equity capital and debt capital, such company is regarded as geared company. We explained that last week. We now discuss risk. What is risk? Risk is the variability in your business return. Risk is variability in business return or investment return. You can also define risk as volatility in return. When your return is not stable, that is what we call risk. Volatility, variability, or fluctuation in investment return. We now explain that risk can be classified into two. You have business risk and you have financial risk. What is business risk? We explained this last week. Business risk is the risk that a company may achieve low profits or the company may incur losses as a result of the nature of the business the company is involved in. Let me take that again. Business risk. The risk that a company may incur losses or achieve low profits due to the nature of the company's business. Business risk has to do with the nature of your business. Like banking business, we have a peculiar risk with banking business. You have construction business. There's a peculiar risk with construction business. You have educational business. There's a peculiar risk with educational business. So business risk has to do with the nature of your business. We now look at measurement of business risk. How can we determine the business risk of a company? How can we measure the business risk of a company? You can measure business risk by calculating the operational gearing. You can measure business risk by calculating operational gearing, which is calculated as contribution divided by profits before interest and tax. You can use that to measure the business risk. We have alternative formula for operational gearing. You can compute the alternative formulas that we have. You can use total fixed cost divided by the total variable cost. That can also be used to calculate operational gearing. Please remember, operational gearing is used to measure business risk. And please, those joining the class, my class today, as much as possible, we try to carry ourselves along. But the rule is, try to be part of the class by making sure that you also write down something. This is to keep you active in the class. As we are having this class now, it's not impossible that somebody is at home taking his dinner. It's not impossible. It's not impossible that in the course of the lecture, somebody can just slip off or slept off. It's not impossible. But to keep yourself active in class, make sure you are putting down small things. All right, that's by the way. You can measure your operational gearing by looking at your total fixed cost divided by your total variable cost. Then number 3 alternative is to use your total fixed cost divided by your total cost, the total cost of the company. Any of these 3 methods can be used to calculate operational gearing. Remember, operational gearing is used to measure business risk. We now have financial risk. What is financial risk? This is the risk over and above normal business risk. All companies will have business risk. All companies, you are going to have your own business risk. Financial risk, this is the additional risk over and above the normal business risk. This risk arises because there's debt capital in the company's capital structure. Financial risk arises because there's debt capital in the company's capital structure. Financial risk is purely associated with debt capital. The only reason why a company will have financial risk is because the company has borrowed money. If your company has not borrowed money before, your financial risk will be zero. So please note that. Now, how do we measure financial risk? You can measure financial risk by using financial gearing. You can measure financial risk by calculating financial gearing. What is financial gearing? The ratio of long-term debt to equity fund. Financial gearing shows the extent to which a company is financed by debt. Financial gearing shows the extent to which a company has borrowed money. So you can look at long-term debt divided by shareholders' fund. You can do this. We have other methods. Also, you can measure your financial risk by looking at the interest cover ratio. Interest cover ratio can also be used to measure financial risk. What is interest cover ratio? How do we compute interest cover ratio? Interest cover ratio, this is the number of times the company's operating profits covers interest expense. We explained this last week. What I'm trying to do is a recap for 15 minutes. Your interest cover ratio is the number of times your operating profits covers your interest expense and is calculated as profits before interest and tax divided by interest expense. The higher the ratio, the better for the company. Lastly, you can use debt ratio to measure your financial risk. What is debt ratio? Your debt ratio is the ratio of total liability to total assets. I want to thank you guys for muting your speaker. Thank you for muting your speaker. Because those little distractions can affect our timing. All right. We said you can compute debt ratio so as to measure the level of financial risk of a business. Debt ratio is calculated as total liabilities divided by total assets. Or you can compute as total debt divided by total assets. Reasonably, assets should be more than liability. For a company to survive, your asset should be more than your liability. If your liability is more than your asset, that means the company is in trouble. All right, we explained this last week. We now look at question number 1. Please refer to page 150, your study pack. Page 150, 151 of your study pack. Earpiece. Earpiece. That question we started last week. And we have to complete that question tonight. So we are going to quickly read the question again so that we all follow the question. We now try to complete the question now. All right, any question, please?
Good evening.
Any question, please? All right, please.
Good evening, sir. Good evening, sir.
Yeah, good evening.
Sir, I just want you to let me shed more light on the prior charge capital. That prior charge capital, it includes what and what? Is it prior year charge capital or prior charge capital, and what
All
are
right,
the components?
thank you. Let us, please, can you write it down? Your prior charge capital is equal to, which is also in the question. And please, it's in the question also. Let me show you, because this material is with us. We have the material. But I want to also show you that financial risk measurement. Where is it? Okay. Okay, let me move up a bit. Look at it, clearly stated. Prior charge capital is equal to long-term debt capital plus preference share capital. Please, can you write it down?
Okay, sir.
The material you have is detailed with explanation. All right.
Okay, sir. What I'm just concerned about, is it prior year or just prior charge
please.
capital?
Do not interpret out of context. It is called prior charge capital, not prior year.
All right, sir.
Don't interpret what is not interpreted. If you want to compute your prior charge capital, it's calculated as your long-term debt capital plus preference share capital. Now, why do we call it prior charge? If you look at this capital, before you are going to pay dividend to shareholders, you must pay interest on debt capital first. And you must pay dividends to preference share capital shareholders. Why is it called prior charge capital? It's because this capital, they will get their return before the owner of the company will get their own return. The debt holder will collect interest. Interest is paid to debt holder. After you pay interest, you now pay tax to government. When you finish paying your tax, if there's preference dividend in the question, you are going to pay preference shareholders their dividend first. That's why we call it prior charge capital. I hope that is clear, please.
Thank you, sir.
All right, let's go back to that question. Question number 1, page 150. Epis, a company called Epis, plans to raise $5 million in order to expand its existing chain of transport businesses in Nigeria. It can raise the finance by issuing 10% loan stock, redeemable in 10 years' time. Please underline, this company is trying to raise $5 million. It can raise the money by issuing 10% loan stock. A loan stock is a debt finance. A loan stock is a form of borrowing. Or by a rights issue of $4 per share. A rights issue is an equity financing. So the company has a choice to finance, to raise the finance by borrowing $5 million through loan stock or by issuing equity, right issue, by issuing equity that was 5 million naira, $5 million. Next, the current financial statement of Epis are as follows. We are giving the statements. You have statement of profit and loss. Look at it now. What we call prior charge. This interest is paid. This interest is paid first to debt holder. After you pay interest, you now pay tax. This profit after tax belongs to shareholder. That's why they call it prior charge. Those are the capital that will get their return first. Before shareholders will get their own return. Okay. We are also giving change in equity. What this simply means is that out of these profits, the company will pay dividend of 2,394. Then the retained profit, retained earnings for the year, 1,596. This dividend is 60%. We are also giving the statement of financial position. Now look at the statement you are giving. Net non-current assets, 20,100. Net current asset, 4,960. Now look at the second part. Ordinary share capital, par value, 25 cents. It's worth 2,500. Retained profits, 20,060. Your Retained profit plus share capital is what we call all this money. These two money belong to the shareholders. The share capital plus the retained profit. It belongs to what? Shareholders. It's their money. Part of their profit retained in the business. Then you now have 12% loan stock. This is a debt capital. That means this company in question, Airpeace, is financed by equity shares and debt capital. This company is financed by two types of capital: ordinary share capital and loan stock capital. Loan stock is a debt capital. So if you look at this company, this is a gears company. A gears company financed by equity and debt. Excuse me, please. Please, let us maximize this online class. The energy we put to it, we want to try as much as possible to mirror physical class. All right, may God give us a better understanding. Let's continue. Look at the last paragraph. The expansion of business is expected to increase sales revenue by 12%. That means if this company is expanded, revenue will increase by 12% in the first year. Variable cost of sales makes up 85% of cost of sales. That means, as you are reading question, you must quickly be interpreting this. If variable cost of sales is 85% of cost of sales, that means the balance is fees. Out of 100%, 85% is variable. That means 15% is the fees cost of sales. Admin costs will increase by 5% due to new staff appointments. Airpeace has a policy of paying 60% of its profit after tax as dividends and has no overdraft. Requirement A says, for each financing proposal, prepare the forecast profit or loss after one additional year of operation. Just 1 minute. Washington. Let's continue. So the question says, forecast statements for 1 year, profit or loss. This we have done last week. We have treated A part. We are on B part. The B part says, evaluate and comment on the effects of each financing proposal on the following. 1. Financial gearing. 2. Operational gearing. 3. Interest cover ratio. And 4. earnings per share. So we are on number 2. Sorry, we are on part B. On that part B, look at it. We have treated the financial gearing. The financial gearing is prior charge capital divided by shareholders' funds. We have currently, what is the company's financial gearing before the expansion? Before the expansion, this company has a loan stock. What is prior charge capital? Long-term debt plus preference shares. We computed this last week. We also look at the alternative. The alternative is your prior charge capital divided by total long-term capital, which is prior charge capital plus shareholders' funds. Please, your shareholders' funds is share capital plus reserves. Look at it, please. For this question, look at it. Look at the share capital, 2,500. Retained profit. Retained profit is the reserves. Money not distributed. That means if you want to get shareholders' funds, you add these two together in the current year. We computed this. Now our working will start from operational gearing. Our working tonight will start from operational gearing. To calculate operational gearing, your fixed cost over total cost. Now let us go back to the statement. For the current year means before the expansion in business. What is this company operational gearing? We now look at after expansion. If the expansion is financed by loan stock, this is loan stock now. Because some might be wondering, this is loan stock. Loan stock. This is right issue. Because some might be wondering, where is the equity finance now? Right issue is equity finance. You can either finance the expansion by a loan stock or you finance by right issue. Now, let us go and calculate the total fixed cost and the total cost. Let us go back. Currently, from the statement given to us, look at admin. Look at this admin cost. Admin cost is a fixed cost. What is fixed cost? Remember your knowledge of costing and your knowledge of financial performance. Fixed cost. These are costs that remain fixed. It's not based on the volume of production. Admin cost is a fixed cost. You are going to pick 14,000. Also remember, the examiner says, look at these comments here. Variable cost of sales makes up 85% of the cost of sales. That means if you come here, this cost of sales is total. 85% is variable. That means 15% is fixed. If you compute 15% of 30 now, compute 15% of 30,000, what do you have?
45.
45. That means our fixed cost of sales is 4,500. Our admin cost is 14,000. That means total fixed cost currently. You can do the working down here. Let's do the working. Because if you don't do the working now, let's do the working down here. Let's show the working. Although we haven't done it before, let's show the working here. All right. Let's continue with our work. I'm gonna pick my pen. Now look at the working. Working. Maybe working 5. I'm not sure. Total fees costs currently. You have fees cost of fees, which is equal to 15% of 30,000. That gives us 4,500. We have admin cost, which is currently 14,000. That means total fees cost currently is 18,500. Return back to your calculation. Total fees cost currently 18,500. Now let's get total cost. Let's get the total cost currently. We are referring to the current statement. What is total cost? Cost of sales plus admin. Your total cost is fixed cost plus variable cost. Your total cost is going to be your fixed cost plus your variable cost. Now, if I want to take it, our cost of sales, 30,000. Our admin cost, 14,000. Total cost currently is 44,000. Now, please note, when you are computing, interest and taxation are not included. Let me repeat my point. If you are calculating costs, we don't include the interest and tax paid. The cost you are going to calculate is what we call operational cost. Cost incurred as a result of operation. Your interest is interest on loan. That interest is not within the control of the business. Your tax is also not within the control of the business. When you are computing this ratio, you are going to look at those costs within the business control. So you don't include interest, you don't include taxation. So if you want to get the total cost currently, you can go and show it so that when you are looking at the workings, total cost currently, what happened? I've overtaken it far. We are going too far. Okay. The only thing I drag the class, but if you are able to follow this, I can assure you that by God's mercy, you can pass your wide room. Look at it, please. Come here. Total cost currently. When we say currently, before the expansion, our cost of sales, it includes both variable and fixed. Cost of sales is 30,000. Admin cost is 14,000. Therefore, total cost currently 44,000. You can return back. Some students, I know them, they also copy in the class. They already have their notes saved. I know some students. They already have their notes. This is 44. You can compute now. Or let's continue. We come and compute later. Now, if the expansion is financed by loan stock, what is total fixed cost now? What is total cost? Go back to the statement we prepared last week. Is an error here. Translation. Okay, fantastic. This should be 28, 5. It should be 28. This is 28, 500. This is 2. 28, 500. Now look at it. Look at our fixed cost. If the expansion is financed by debt, we have fixed cost of sales, 4,400. We have admin cost, 14,700. Please add these two together. 4,500 plus 14,700.
19,200. 19,200.
That means whether we finance by loan stock or we finance by right issue, the total fees cost in 1 year's time will be 19,200. Look at the variable cost. The only variable cost we have here is variable cost of sales. The only variable cost we have here is variable cost of sales, 28,560. We can go back now. I can come here. Total fees cost here, 19,200. 19,200. Our total fees cost is calculated as fees cost of sales plus admin cost. Our total cost now, let's go and calculate. Let me do the working because 4,400 plus for debt finance or equity. We have fees, cost of sales, 4,500, 4,500. We have admin cost. We have 14,700, 14,700. Therefore, total fees cost 19,200, 19,200. Our variable cost of sales, variable cost of sales, we have 28,560, 28,560. Therefore, our total cost, fixed cost plus variable cost. Please, what is the total cost? Total cost. Please, sum together. Oh yeah, yeah. Where's Moses? Oh yeah, let's sum together.
47,760.
47,760.
47,760. Thank you. You can return back to your table. This is 47,760. Let me remove it because some students might not be in class today. So that let's maintain 47,760. You can compute your operational gain. Look at the formula. Fixed cost divided by total cost. 18,500 divided by 44,000.
42.0.
42.05. 42.1 approximately.
I got 0.42.
Is it 4.2?
4.2. Well, I'm wondering.
Okay, 42.05.
Don't worry, if I don't multiply by, don't even multiply, it's not a problem.
Okay.
But it can be from 4.2.
No, it's 42.
It's 0.42.
Exactly.
0.42. If you multiply
Yes.
by 100, you have 42%, have you?
Yes.
42.1%.
It's actually 42.04. So
Is
yes.
0.04.
It's not 42.1. It's 22.05. Hello, sir. 42.04.
Is
45. So we approximate it.
Okay. Voila.
So it should be we can leave it at 42% because it's
no
0.4.
I'm trying to get I'm trying to pick my pen. $42.0. No problem. Now compute for if 19,200 divided by 47,760. What do we have?
40%.
40%.
40%. 40%.
40%.
Can you see it? Before the expansion, the business risk was 42%. As a result of expansion, the business risk has reduced to 40%. That expansion in business has reduced the risk. Whether we finance by loan stock or we finance by rights issue, business risk is 40%. We can also use the second formula. You can use the second formula to calculate your operational gearing. Total fixed cost divided by total variable cost. Our total fixed cost here is 18,500. Here is 19,200. Here is 19,200. Total variable cost here, if you remember, is 25,500. You know how we got this? You know how we got this?
No, sir.
Yeah, 85%
Okay,
of
let's
30,000.
Yes, sir.
85% of your cost of sales. Look at it. The question says, look at your cost of sales, 30,000. The question says, variable cost of sales makes up 5% of cost of sales. Compute 85% of 30,000. That is your variable cost. Please compute. What do we have?
$25,500.
That's all. And we know the variable cost for this. You go to the statement we prepared. Look at the statement. Under debt finance, variable cost of sales is 28,560. Under equity finance, variable cost of sales is 28,560. Here is 28,560. 28,560. Please compute your operational gearing. Total fixed cost divided by total variable cost multiplied by 100.
Approximately 73%.
Yeah, 73.
Approximately 73%. Compute what you have here. It should be 67%. This you confirm.
Yes, 67.
Please note, you will get the same figure, but your comment will be the same. Look at it. Before the expansion, the business risk is 73%. As a result of the expansion, the business risk has reduced to 67%. Whether we finance by loan stock, debt finance, or we finance by equity rights issue, the expansion will reduce our business risk. The expansion will reduce our business what risk. Now, we have used two formulas to calculate operational gearing. Look at the the third way. There are three ways of calculating operational gearing. We have shown the first one. We have shown the second one. Look at the third one. Your operational gearing can be calculated as contribution divided by profits before interest and tax. Just go and pick your figure. Let us go to the question. Let us pick our profits before interest and currently.
8,240.
Thank you. What did you call it?
No.
Look at it. Before the expansion, profits before interest and tax is 1,000.
1,000.
After the expansion, let us look at the profit before interest and tax.
Okay, that's the one.
After the expansion, 1 year's time, 8,000 what?
8,240.
Whether you finance by loan stock or you finance by rights issue. So pick that first. I'll come here. Currently, PBIT is 6,000 here. Here we have 8,240. 8,240. Now let's go and compute contribution. Our contribution is what? Sales revenue less variable cost. Is that not?
Yes, please.
Working. 6. We have current, debt finance, equity finance. Go and pick the sales and pick the variable cost. The variable cost here is 25,550.
500.
The variable cost here is 28,560.
560.
Variable cost here is 28,560. Let's go and pick our sales.
Sales revenue is
to the income
50,000.
statement. Thank
Sales
you.
revenue $50,000.
Currently $50,000.
$50 million.
Let's look at sales revenue in 1 year's time, 56,000.
Okay, 1 year's time.
56,000.
So let's go back. Honestly, bringing FM to this side will help you when you get to find. Come here, this is 50,000 currently, 56,000, 56,000. Please compute contribution.
For current, 24,500.
24,500. What do you have here?
27,440.
27,440. 27,440. You can return back now. This is 24,500. This is 27,440. This is 27,440. You don't need to multiply with 100 yourself. Please compute what you have.
4.1.
4.1,
Yes.
3.3, 3.3. Is that not? Is that correct, please?
Yes, sir.
Yes, it's correct.
Now,
But why
what
are
will
we
be your
multiply
comment
by
now?
100?
It's not compulsory for this particular issue. It's
Okay.
not compulsory to multiply by 100.
Okay.
But if you multiply by 100, no problem. You are still going to. It is your comment that is most important, not the figure. What will be your comments here? Yes? What will be our comments? Before the expansion, the business risk was 4.1. As a result of the expansion, the risk has reduced. Whether we finance by loan stock or we finance by right issue, the business risk of this company has reduced. So in exam, please, in exam, I've shown you the three formula for calculating operational gearing. In exam, just pick one. If you are asked to calculate operational gearing, look at the question you are giving. Look at the data contained. Anyone that fits into it, use it and calculate. All right. Next, the question says we should calculate interest coverage. We are asked to calculate the interest coverage. The formula is profits before interest and tax divided by the interest expense. We know this, our PBIT, currently 6,000, 8,240, 8,240. Now go and pick your interest. What is the interest expense currently?
300.
Go to the income statement.
300.
300 currently. Now let's go and check. If the expansion is financed by debt, that is loan stock. What is the new interest?
800.
300.
800, 300. Pick your figure and go. This will be 300, 800, 300. Now, please calculate interest cover ratio. Please don't multiply by 100 here.
That's
This calculated
20.
20 times. This 20 times is calculated in times. What do you have here?
10.3.
10.3 times. What do you have here?
27.4.
27.5.
0.5.
Yes.
Approximately.
Yes.
Approximately. No problem. So what will be your comment here? Remember we said interest cover ratio. The number of times The company's operating profit covers interest payment. The higher the ratio, the better for the company. Currently, the interest cover ratio is 20 times. If the expansion is financed by loan stock, the interest cover ratio will reduce to 10 times, which shows that the financial risk has increased. It means that the company is not making enough profit to cover its interest expense. Look at this. If the expansion is financed by rights issue.
Hello, sir. Please come again.
Don't worry. We are going to the comment after the computation. What I simply say is that if your interest cover ratio is falling, it's not a good sign. If the interest cover ratio is falling, it's an indication that the financial risk is becoming high. But if the interest cover ratio is rising, it shows that the financial risk is falling. All right. The last computation says calculate earnings per share.
Sir, excuse me.
Yes.
Can you repeat the comment? I didn't get it.
I said your interest cover ratio shows the number of times the company's operating profit covers interest expense. The higher the ratio, the better for the company. Now look at it here. Before it was 20%. Under debt finance, it has gone to 10. Sorry, before it was 20 times. Under debt finance, it has come to 10 times. What has happened now? The ratio is falling. Is that not? This is not good for the company. Look at this. If the expansion is financed by rights issue, this ratio will rise. That means financial risk is reducing. Is that better, please?
Understood, sir.
So always remember, the higher the ratio, the higher the interest cover ratio, the better for the company. Why the lower the ratio, the riskier for the company. The more risky for the company. Now the last ratio. Examiner says calculate earnings per share. What is the impact of the expansion on earnings per share? Your earnings per share is calculated as your profit after tax divided by number of ordinary shares. Your earnings per share is calculated as your profit after tax divided by number of ordinary shares. Now go to your income statement. Go and pick your profit after tax.
57. Oh no, profit after tax 3990.
Currently is 3,990. Now let's look at in 1 year's time. What is the profit after tax? Look at it, please.
744 for debts.
No, what are you looking at?
5208.
5208.
Okay, yes.
5208.
Better use your glasses, so
5208.
that is
5558.
under loan stock is 5208. Under right issue 5558. Now let's go back.
Yeah, I want focus. What I'm doing.
Here we have my pen. 3,990, 5208, 5558. Now let's go and get number of ordinary shares. Let us look at the statements. You are going to get this from your statement of financial position. Look at it. Ordinary shares, par value, 25 cents, just like 25 kobo. The amount, 2,500. So you need to divide now. 2,500 divided by 25 cents.
Yes,
Let's go and show
10,000.
the working. Thank you. Well, let me show the
10,000.
workings. I know you are correct. That will give us 10,000 shares. But it's better for me to show the workings because it's good for us. To get number of ordinary shares, you need your, let's have this. We have current, under debt, under equity, share capital. The share capital here is 2,500. No, not 25,000. No. $2,500. Why now? My mind is thinking of plenty money. The more the zero, the more the money. This is dollar amount. The par value. The par value is what we call the nominal value. This is 25 cents. So it's just like 25 kobo. You need to convert this to dollar also. You are going, you want to divide naira by kobo. Both of them must be either in naira or kobo. If I want to change 25 cents to dollar, it becomes 0.25. So 2,005 divided by 0.25.
That's 10.
Number of shares here. Number of shares here will be
10,000.
10,000 shares. Now, let me ask the class. If the expansion is financed by loan stock, will you have your share capital? Your share capital change?
No.
No,
The
sir.
share capital will still remain 25.
Why, sir?
This one is loan.
Okay, let's answer. I say why. If you borrow more money, will your share capital change?
No, sir.
No.
Debt,
I've
loan stock
gotten
is
it. I thought
borrowing
you
now.
were
If you borrow money, will you go and change your share capital?
No. It
no,
will only
no, no.
increase my debt.
Then it will only increase your debt. Your share capital will still remain 2,500. That means nominal value will not change. Nominal value will never change. This will still be 2,500. The share is still 10,000. Now, assuming you issue more equity, will your share capital change or not?
It will
It will
change.
change, sir.
It will change.
It will change. You know, we are going to issue equity to make 5 million, Abby.
Yes, sir.
We want to raise $5 million, Abby. That means
Yes, sir.
if you do rights issue, you are going to generate additional $5 million plus existing 2.5. That means your share capital will be how much?
Sir, pardon?
7.5.
7.5.
Let me explain it again. I said the question is you want to raise more money. You want to finance expansion. You are not looking for 5 million. You have a choice between loan stock or rights issue. Loan stock is debt finance. Now, my first question was, assuming you finance the expansion by loan stock, will your share capital be affected?
Loan stock, no.
No. That means share capital will still remain 2,500.
Yes, sir.
Now, assuming, okay, this is my case. I will adjust this. Assuming you finance the expansion by rights issue, will your share capital be affected or not?
Yes, sir.
Yes, sir. To be affected.
Thank you. Your share capital will rise. But it's not going to be by 5 million because you know why? These shares are issued at
4 naira per share.
4 naira. Is that not?
4 naira per share, yes, sir.
$4.
$4.
That means the share has been issued at a premium.
Premium.
Yes.
The nominal value is 25 cents. You now issue share at $4. That means you have issued the share at a premium. Is that not, please?
Yes.
Yes, sir. 3
Under your FR, is that not?
Yes, sir.
So we can't take all this. Your share capital will only take nominal value. Your share capital will only take nominal value. Okay. To simplify this so that I don't get you too much out of it. So I want to do this now. For simplicity, I'll come here. Look at this. Before we have, look at it too. For simplicity, to minimize under equity, for under this equity here, I want to work it here. Under equity. Currently, we have 10,000 shares. We now want to raise 5 million. And price per share is $4.
4 naira.
How many shares are we going to raise? Are we going to issue? Under rights issue, We are trying to raise 5,000. The price per one share is 4. How many shares are we
4.
going to issue?
We divide 5,000 by 4.
Correct.
One
How
million,
many shares will that give us?
1,250.
250.
1,250,000.
That means under equity finance, number of share is 11,250 shares. Instead of going through this long route, instead of separating between share premium, nominal value, just take the easy way out. You are trying to raise $5 million at a price of $4 per share. How many shares are you going to issue? New shares. Just divide your 5,000 divided by 4. That means you have gotten the shares. Now come here.
Daddy, please, can you to break it into the share capital and the premium in it, sir?
What do you say?
Please, what's the premium value if we are to break it into shares and premium?
Okay, I'm coming. This will give us 11,250, Abby.
Sir,
Is that correct? 11,250, Abby?
Yes, sir.
Yes.
Yeah. I'm coming back to your question. Now you can compute your earnings per share now. 3,990 divided by 10. This will give you 0.399. This will give us in dollar 0.5208. What about the last one, please? 0.49 something. Let me check. 0.49.
4.
494.
That's 0 points. Yeah.
You have computed your earnings per share. Hold on. Now, please note. You can compute earnings per share in Naira or in Kobo. If you look at this, we didn't multiply by 100. That means I want to leave my answer in dollar. If you want to compute in cents or in Kobo, multiply by 100. That will give you in Kobo. Let me repeat my points. Earnings per share can be calculated in Naira value or in Kobo. To calculate in Naira, do not multiply by 100. Divide your profit after tax by number of ordinary shares. To calculate in Kobo, when you finish dividing, multiply your answer by 100. All right, first, I have one question. Somebody says, if you want to separate the premium and nominal value, how do you do it? Now, Oluchi, let me hear your question.
okay, sir, please, my question is based on the workings for the number of ordinary shares. On the equity side, you know that the share was issued at par value, at premium. So, which value are we going to use as par value? Are we going to use 3.75?
That's your question.
Or are we going to still use 0.225? Yes, sir.
Is that your question, please? That's the same question somebody asked me. As me, we want to treat.
Yes, that was the same question I had, sir.
Now, if you want to treat the other way around, look at it. Nominal value is, now the share was issued at the new share. Price of new share is $4. You now come here. The nominal value. Nominal value is also what we call the par value. Nominal value is 0.25. Is that no? That is 25 cents.
Yes, sir.
That means the premium is
3.75. 3.75. 75.
Now, if you are going to not separate, the share capital will be, we are going to issue 1,250 shares at a par value of 0.25. Please multiply. The premium will be share premium. 125 shares multiplied by the share premium, 3.75. Please multiply. What do you have here?
First, we have 312.5.
312.5. Then what do you have here?
Yes, sir. We have 4687.5.
4687.5. Now add the two together. Let me write it very well, please.
$5,000.
How much are we trying to raise? 4687.5. 5,000. This amount will go to your share capital. That means if I want to go back now, before our share capital was, before the right issue, the share capital was how much? Currently, share capital 2,500, Abi. Is that not?
Yes, sir.
Yes, sir.
Plus
Yes,
new
sir.
share capital. Plus new share capital. That will give me 312.5. That means your share capital now will be, add together, 2812.5. This amount, this is your new share capital. This amount, 4,687.5. This will be posted to your share premium account. If you go back now, if I take this off now, this will be 281 words.
2.5.
2812.5.
2812.5. 2812.5.
5.
This is 0.5. This is the share capital value if the expansion is financed by right issue. If you now want to confirm, now divide it by 0.25. Number of shares. You are going to get 11.
11.
Is it better, please?
Yes, sir.
So, but in exam, you don't need to create. If you want to do it, no problem. Oh. What is important is give us the number of shares. So in exam, just pick the Naira amount, $5 million, divided by the price per share. That will give the number of shares you need to issue. But also this knowledge will also help you. We are done with the computation. We are done with the computation. Look at it. Now look at it. As an investor, the investors will be interested in that options that will increase their weight. Currently, earnings per share is 0.399. If the business is expanded and the expansion is financed by loan stock, the weight will increase to 0.52 per share. Alternatively, if the expansion is financed by rights issue equity, the weight will increase to 0.49. Assuming you are a shareholder, which option are you going to select?
Debt financing.
You will say, please, finance the expansion by borrowing money, because this will increase shareholders' weight. We give shareholders' weight the higher earnings. But now, look at the second aspect. This is for the income side now. It's normal now, Joseph. Jojo, my friend. You always get the working note after the class. Joseph Etuk, am I correct? The working notes will always come. Now, from the angle of earnings, debt finance is better for the shareholder. Now, let's look at the angle of risk. What I'm trying to say is, when you are looking at investment decision, when you are considering investment decision, you are going to look at return and risk. The return is earnings per share. What about the risk? Look at it. Measurement of risk. Look at the interest cover ratio. If you finance this expansion by debt, the interest cover ratio will fall, which means that the financial risk will rise. Alternatively, if you finance by rights issue, the interest cover ratio will increase, which implies that the financial risk has reduced. Also, look at the gearing. Look at the gearing. Before, the level of financial risk was 11%. If you finance by loan stock, financial risk will increase to 30.4%. Alternatively, if you finance by rights issue, the financial risk will fall. That means, which option is better now?
Yes. Equity finance.
In terms of risk, please, the first person, debt is not better.
Okay.
In terms of risk, the risk will increase if you borrow more money.
Yes.
In terms of risk, equity finance is better. In terms of return, debt finance is better. So what will be your advice to the investor?
Since every business have its own side risks, there's no business that is not risky. I will prefer my money to be more. I will prefer the
You will do what?
the loan. Since every business is associated with its own risks, I will still prefer the loan.
You prefer
Debt.
the loan. You are
Debt.
prepared to take higher risk and get higher return. Is that Is that
That's,
what we are saying?
yes,
Yes, sir.
All
You
right.
know, it's opinion. Oh. Some people might say no, they can't take the risks. But for my side, I can just try and take the
So we are
risks.
not talking about you now. You
Oh,
are a
okay.
consultant. You need to
Oh,
advise
okay.
your clients.
Oh, okay.
Now look at the comments. Look at the comments. Please, these comments, of course, we type it to make it easier. Please don't ignore it.
Mm-hmm.
Now look at this. The debt finance proposal leads to the largest increase in earnings per share, but results in increase in financial gearing and a decrease in interest cover ratio. Whether these changes in financial gearing and interest cover ratio is acceptable depends on the attitude of both the investors and the managers to the new level of financial risk. A comparison with the sector average would have been helpful in this context. Assuming you are giving the sector average, that is the industry average, we should have benchmarked this against the industry average. Next, the equity finance proposal leads to decrease in financial gearing and increase in interest cover ratio. The expansion leads to decrease in operational gearing, whichever measure of operational gearing used, indicating that the fixed cost has fallen as a percentage of total cost. So the choice is for the investors and the company. If they are willing to accept higher risk, they should go for debt finance. If they are trying to minimize their risk, the expansion should be financed by right issue. Then the last aspect of the question. Comment on the view that businesses are unlikely to have higher financial gearing and higher operational gearing. That would be too risky. If your financial gearing is high and your operational gearing is also high, that business will be at a very higher risk. Remember, financial gearing, that measures your business risk. So that measures your financial risk. While operational gearing measures your business risk. What happened? You are tired. Look at the
Sorry,
comment.
sir, please ask the question.
What do you say?
I said I want to ask a question.
All right, go ahead.
So is there like a standard for a standard ratio for the gearing to know if it's very high or it's
Yes, that's what we
normal?
said now. That some question they will give you sector average, the industry standard. In this question, we are not giving the industry standard. Look at the comments here. A comparison with the sector average would have been helpful in this context. Assuming you are giving that example says The industry average is 50% or 30% or 20%. You now computed your own. Your own is now more than 30%. That means the risk is high. Is it better, please?
Yes, I did. Thank you.
Yeah, AY. Ayo, please speak with us.
Sir, my own question goes like this, because at least I did not
Yeah, I can't hear you. I don't know about that. So,
but I'm trying to get one or two things. Like for instance, now this financial journey now, you mentioned based on like the debt financing now. That one is. Can you hear me now? Right?
yeah, I can't hear anything. Though.
Can you hear
His
me
network is bad.
right now, sir?
Please go ahead.
I said like this financial journey now. You mentioned about the debt finance now. That one is good in return, while the equity side is good in risk aspects. And then for this operational journey now, that's what I want to make confirm now. Like because if you are looking at the operational journey now, the debt financing and the equity financing, both of them are the same. Like for instance, now which one can we advise that the company should use?
Okay. Thank you for that observation. How you finance your business will not affect your business risk. Let me repeat my points. Thank you for that observation. Whether we finance by loan stock or we finance by rights issue, the business risk is the same. How you finance a project will not affect your business risk. Business risk is independent of financing. It has to do with the nature of your business. So in this question, business risk will not have any effect on our comments, because what we are trying to do is to finance expansion. Your business risk has to do with the nature of your business, not your method of financing. Is that clear, AY?
Yes, sir. Yes, sir.
All right. Look at the comment on this. As operational gearing increases, as a company's operational gearing increases, a business becomes more sensitive to changes in sales revenue and the general level of economic activity. What that statement is saying is that if your business risk increase, the company become more sensitive to sales value, sales revenue, because any small change in your profit will affect your business. Increase in operational gearing is an indication that there's increase in your business risk. Financial risk in the context of this question can be described as the possibility of a company experiencing changes in the level of its distributable earnings. Remember, we define financial risk. The possibility of a company experiencing changes in your earnings to shareholders as a result of debt finance. As a result of the need to make interest payment on debt finance. Financial risk happen as a result of debt financing. In this case, the earnings volatility will depend not only on the business risk, but also on the financial risk, on the proportion of debt finance in the company's capital structure. What we are saying is, once you introduce debt finance into your business, that means your business is exposed to both business risk and financial risk. It is likely that a business with higher operational gearing will have low financial risk, low financial gearing. What that means is that it is very possible that a business with higher business risk will have low financial risk, and a business with high financial risk will have low business risk, because the managers are concerned with the level of risk. Excessive risk, manager will be concerned with excessive level of risk. A business with combined higher operational gearing and financial gearing, meaning that if your business risk is high and your financial risk is high, that business clearly runs an increased risk of experiencing liquidity problem. Where you have higher business risk and higher financial risk, that company runs the risk of liquidity problem. Making losses and becoming insolvent. The summary is that if you are aware that your nature of business is highly risky, then you must try to reduce your financial risk. If you are aware that the nature of your business is highly risky, then you need to reduce your financial risk. Wow. We are done with that question. I wish to do the second question. That is page, I think page 52 or so. Baswani, yes. Oluwakemi.
Thank you, sir. Sir, please, is there any relationship between earning per share and dividends?
Is there any relationship between earnings per share and what?
And dividend?
Of course. Of course, there is relationship between earnings per share and dividends. Your dividend is coming from your earnings. Your dividend is coming from your earnings per share. Most likely, if your earnings is high, your dividend is likely to be high. So there is relationship between the two. Relationship is that earnings per share. This is profit attributable to ordinary shareholders divided by number of shares. Why dividend is percentage of the company's profits that is distributed to shareholders divided by number of shares. The difference between the two, differences between earnings per share and dividend per share, is what we call retained earnings per share. The differences between earnings per share and dividend per share is what we refer to as retained earnings per share. So there's relationship between the two. It is from your earnings you get your dividends. Any question, please? Obviously, with this timing, even before we read this question finish, it's already 11 o'clock. So what we do is this. Please refer to page, I think page 151 or 152. Go and look at that question number 3. Vaswani and Co. Now let us try to attempt this question. This question is 95% similar to the question we solved. Attempt the question and revert. When I say revert, send your solution to me privately.